In this video, we're going to discuss big implications when it comes to HST for your garden suite or multi-unit conversion project. If you don't get this right, you could be leaving tens of thousands of dollars on the table, or worse, owe a lot of money to the Canada Revenue Agency. Let's dive right in. Thanks for watching. This is Andy from Suite Additions. If you're new here, we're an architectural design company helping homeowners and investors create more housing units and generate long-term wealth using the Max REIT strategy. Over the years, we've completed many small-scale infill projects and helped over 400 clients legally convert their homes to multiple units, boosting cash flow and house value. Additionally, we have a comprehensive Max REIT strategy in-person training program and investor community. Our next session is coming up. If you're interested, please check out the details in the description below. Also, it would help us out if you can give us a like and subscribe so we can get this message out to more people. So with the popularity of garden suites, laneway suites, garage, and multiplex conversions, basically what we refer to as Max REIT projects, there are a lot of HST implications that most people are unclear about, myself being one of them. It's important if you're involved in these types of projects to be aware of the HST implications and then hire the right professional to help you navigate the process. Not doing so can potentially land you in hot water with the CRA, and also you may be missing out on tens of thousands of dollars on eligible rebates. So in this video, we're going to address this topic from the standpoint of an investor who has purchased property and intending to build new or perform substantial renovations for the purposes of renting it out. We're going to discuss three very important aspects of HST. The first is claiming HST Input Tax Credits, which is HST paid for a project. The second is the self-supply and self-assessment to determine how much you owe to the CRA. And the last is the rebate for the new residential rental property. Now, of course, we need to put a disclaimer that we're not tax experts. The goal is really just to make you aware of these HST implications so that you don't forget about this as part of your project and don't get in trouble or potentially miss out on rebates. I've simply gone through this several times myself, so I have some familiarity of the process. And I've worked with tax professionals to help our company, and I strongly recommend that you do as well if you are involved in these projects. In the description below, we included links to the public websites for more detailed information for you to look into. So with that out of the way, let's get into it. The first thing to note is that if you're an investor of a property for commercial purposes, i.e. an investment property that is not your primary home, you are considered a builder under the Excise Tax Act. And there are various provisions when building and renovating. So now let's dive into the three important aspects of HST. The first is that registrants of HST can claim HST paid as input tax credits, also referred to as ITCs. These would be for recovering HST paid for commercial activity of their property. Activities including the sale of new and renovated real estate and self-supply, which we'll talk about next, as well as renovation and construction costs. Essentially, it would cover operating and capital expenses for an investment property. Builders need to make sure they are HST registered with the CRA. The second important aspect we'll highlight is self-supply and self-assessment. Self-supply is when a builder constructs or substantially renovates a property and then rents it out. This builder is considered to have supplied the property to itself. The owner is required to pay HST on the fair market value of a property they have built or substantially renovated. So for a garden suite, the homeowner would have to pay the HST portion for its fair market value, regardless of whether they are registered for HST or not. In a multiplex conversion, it would be required if it's deemed a substantial renovation. Now, to determine if a renovation is substantial, there are generally three criteria. Number one, if 90% or more of the property is renovated, and number two, it's for the existing building only, and number three, it is removed or replaced. Walls being replaced is an important indicator of whether the renovation is substantial. Now for the final aspect we'll highlight, this is the rebate for new residential rental property. If you're an investor who substantially renovated a home or built a garden suite, garage conversions included, and then rented it out on a long-term basis, then you may be eligible for this rebate. There's a federal portion with a maximum rebate of $6,300 and a provincial portion up to a maximum rebate of $24,000. To claim this, it must be done within 2 years. There is also a new program as well that was released in September of 2023 called the Enhanced GST Rental Rebate. This rebate increases from 36% to 100% of the GST paid on eligible new residential rental properties. This applies to new purpose-built rental housing projects that began construction after September 13th, 2023 and before January 1st, 2031, and substantially completed by December 31st, 2035. Properties that are eligible include new projects with minimum of 4 units, as well as conversion of non-residential real estate into homes. For example, office buildings that are retrofitted to residential. So this is great for those who are interested in building new and can work great in conjunction with max suite projects where you're able to sever the lot. Again, it's important that you work with your accountant and an excise tax expert to navigate your particular situation. I've included relevant links to the 3 items outlined in this video, as well as the new rebate program that was announced last year. It's important to know this stuff as some homeowners and investors have been caught in situations where they have substantially renovated a home or built a garden suite and failed to claim the rebate within the 2-year window. And in some cases, they have been audited by the CRA and then required to still pay HST on their new unit or substantially renovated unit. As part of our Max Suite Strategy training program and community, we have experts in both tax planning and small-scale infill development speak at our training events, and our members gain access to these valuable professional resources. Again, we have a new session coming up. If you're interested in joining our next in-person training VIP group, check out suiteeditions.com/training and you can apply to take part. So have you had any experience with HST for a Max Suite project? If so, please share it in the comments below. Thanks again for watching, and we'll see you in the next video. To learn more about the Max Suite strategy, download our free guides at suiteeditions.com and get started. And if you enjoyed this video, here's another great one for you.